What is fractional reserve banking, and how do banks use it? Imagine walking into a bank with your savings, expecting your money to be safe. But have you ever wondered what actually happens behind the scenes? Banks don't just keep your money in a vault. Instead, they use a system called fractional reserve banking, which is a key part of how modern economies work. This system allows banks to lend out most of the deposits they receive, while only holding a small part as reserves. The reserves are like a safety net, ensuring they can handle some withdrawals. For example, if the reserve requirement is 10%, the bank must keep $10 for every $100 deposited. The rest can be loaned out to people or businesses. When a bank makes a loan, it doesn't give out physical cash necessarily. Instead, it credits the borrower's account with the loan amount. This increases the total money supply because now there is a new deposit in the economy. The borrower might use that money to buy a house or start a business, and when that money is spent, it gets deposited into another bank. That second bank then keeps a part as reserves and lends out the rest again. This cycle repeats over and over, creating more money in the economy. This process is called the money multiplier effect. It helps banks generate profit through interest on loans, which is a big part of their income. From an economic point of view, fractional reserve banking helps channel savings into investments. It makes it easier for businesses to grow and for consumers to buy homes or pay for education. But it also comes with risks. If too many depositors want their money back at once, a bank might not have enough reserves to cover all withdrawals. That's why governments set rules to protect depositors, like deposit insurance, and central banks act as lenders of last resort. These measures help keep the banking system stable and trustworthy. Sometimes, reserve requirements are relaxed or changed, depending on economic conditions. This flexibility allows banks to lend more or less, influencing how much money circulates in the economy. Overall, fractional reserve banking is a clever way for banks to make money and support economic growth. It turns deposits into loans, creating more money and helping people and businesses achieve their goals. While it has its risks, proper regulation and oversight keep the system working smoothly. It's a vital part of how market systems and financial systems operate in capitalist economies, fueling progress and innovation.